Hi, everyone. Thank you very much for connecting to our seminar today. I hope you are all well and that you're all staying safe at your homes. My name is Eric Parrado. I am the Chief Economist and General Manager of the Research Department at the Inter-American Development Bank. For those who are joining us for the first time, this seminar is organized by the IDB Research Department and it's called EconNet. And given the new reality due to the pandemic, we have adopted this virtual format, and most of our upcoming seminars, including the one today, will be covering COVID-related topics that are relevant for our countries in Latin America and the Caribbean. We seek to bring the region closer to the most recent developments and innovations carried out by world-class researchers. And that's why we have today Cristina Arellano, economist at the Federal Reserve Bank of Minneapolis, presenting her new paper, Deadly Debt Crisis, COVID-19 in Emerging Markets. So it's gonna be a really important issue for the future of our economies. As you probably know, Cristina has made important contributions to the literature on sovereign debt crisis, which have influenced the policy discussions in our region. Today in particular, Cristina will talk about the challenges that indebted emerging economies are facing due to the COVID-19 crisis. She will discuss optimal lockdowns and debt policies, as well as the benefits of debt relief in these unusual times. And before passing her the microphone, let me go quickly through the rules that we have adopted to our seminar, and they are really simple in this virtual format. First of all, there will no breaks for questions during the seminar. The speaker will have 40 minutes to present, and then we will have the remaining time for Q&As. During the presentation, you have the option to type your questions in the chat. Joao Aires, one of our research economists, will be the moderator and he will take the questions to ask to the speaker. In addition to that, during the Q&A session, you can use the option raise your hand and wait until we give you the permission to speak. In this case, remember that you will need to turn on your microphone. Now, without further ado, let me pass the microphone to Cristina Arellano. Cristina, thank you very much for being with us today. The screen is yours.
Well, first, thank you very much for the invitation to present this paper, to present my work on the challenges that emerging markets are facing and the risks of a sovereign debt crisis. Now I'm going to share my screen. This is joint work with Yen Bai and Gabriel Michalache, and let me start by saying that the views here are my own and not those of the Federal Reserve System. So as all of you know, we're going through these very challenging times, a pandemic that is very deadly, it's highly contagious. And we're seeing countries imposing mitigation policies, lockdowns to control the disease, save lives. Many countries are engaging in large fiscal transfers, especially advanced economies, to protect and insure their citizens. For emerging markets, the pandemic brings additional problems. We have one of the main challenges, of course, is that emerging markets are susceptible to debt crises. Many are starting the epidemic with large debt, with rising interest rates, with looming defaults, which limits much the fiscal space for governments, makes it difficult for governments to support lockdowns. The pandemic is on top of it a large external shock. There's collapses in export demands, tourism, remittances, sudden stops of capital flows. These are very challenging times. For emerging markets, the COVID-19 epidemic risks not only a health crisis and an economic crisis, but also a debt crisis. Whoops. So let me give you some data. Maybe some of you have seen this type of data already. So the epidemic COVID-19 is growing rapidly in emerging markets. This is data for daily fatalities for a bunch of emerging markets as of a couple of days ago. And you see that sort of Brazil is very much in the news. I mean, Brazil is facing a very large number of fatalities every day, reaching about 1,000 deaths per day. Some estimates of these official deaths across 35 emerging countries is the death toll thus far is about 60,000 people. Likely, the actual deaths are larger than the official deaths. Some estimates of excess deaths relative to official deaths are like 2 for Turkey, 15 in Ecuador. So the death toll is large, is growing, and is likely larger than what official statistics report. At the same time, these countries are, are facing a sort of looming debt crisis. Argentina, Ecuador, Lebanon are already in default. And the borrowing rates or sovereign spreads in this plot, I show you the credit default swaps have risen for many of the countries between 200 and 400 basis points. So what we're going to do in this paper is we're going to analyze this epidemic for emerging markets by developing a quantitative framework that integrates sort of debt crisis and the epidemic into one framework. Let me start by giving you a sort of a overview about what the framework is about before I go into the sort of the formal details. So we're gonna develop this framework, and we're gonna focus on, there's gonna have 2 main points. Okay, the first point is that the epidemic, I'm gonna show you that the epidemic can generate debt crisis. And the second point is that the debt crisis itself can make the epidemic worse. Let me close this. The framework is going to have agents that are going to value consumption and life. Consumption is going to depend on economic production, economic output, but it's also going to depend on the availability of international credit. The life mortality risk is going to depend on an average health state of the population. We're going to start by thinking that before the epidemic hits, the economy is in a pretty benign state, low default risk and good health. We're going to have this COVID-19 shock that is going to be an unexpected shock that generates, of course, a health crisis and increases mortality risk for the agents of this economy. In response to this health crisis, there are going to be mitigation policies that are going to be aimed at reducing the severity of the health crisis. Of course, these mitigation policies will potentially be useful for reducing the health crisis, but it generates economic crisis. It lowers output, and also it lowers the prospects for debt repayment in the future, which is going to generate a debt crisis. Of course, there could be interactions. Low output is going to generate even worse worse debt crisis. A worse debt crisis is going to generate even worse economic outcomes. These 2 forces are going to imply that the costs in terms of consumption from the debt crisis are very severe. So here we can see the first point that we're going to make, which is that the epidemic is going to generate not only an economic crisis, but a debt crisis because it lowers repayment prospects in the future. Now, then comes the second part. So when, the costs in terms of consumption because of this cost debt crisis are very large. So that is going to imply that there's going to be a force that is going to push towards a relaxation of mitigation policies, and so lower lockdowns, lower mitigation interventions. And that in turn is going to alleviate the economic debt and the debt crisis, but it's going to make the health crisis worse. So here we come to their second point, which is that the debt crisis is going to make these mitigation policies more costly, which in turn are going to increase potential fatalities from the epidemic. So you see that in this framework, what's happening in the debt is going to be important in both determining the outcomes for consumption and for the mortality of this epidemic. So the third point that we're going to make is we're going to analyze debt relief policies maybe is a little bit extreme here in the plot, but what we're going to think about is what would happen if institutions like they are doing, the World Bank, the IMF, the IDB, is providing these debt relief policies for emerging countries. And what that does is going to ameliorate the cost from the debt crisis. It's going to lower the probabilities of a debt crisis, and is going to support consumption. But not only that, it's going to reduce the cost of mitigation, and it's going to allow for more thorough mitigation that in turn is going to alleviate the health crisis. And so what we're going to find is that debt relief is going to provide a positive social value, because it's going to not only alleviate the debt crisis, but it's also going to alleviate the health crisis of these countries. So the rest of the talk is going to be formalizing these pictures, okay? But before that, let me give you quickly a preview on the quantitative findings, because what we are doing is actually providing a framework, but also trying to give sort of a quantitative answers to this. So the first thing that we find is that the epidemic is going to generate a long debt crisis with lockdowns that are going to last about 8 months, okay? But with about 2 or 3 months, very high intensity, about 50% of intensity in terms of lockdowns, and then slowly, increasingly relaxed lockdowns as the epidemic continues. This is going to be useful in reducing the fatalities from the epidemics of about 0.5%. It's going to lead, though, to a debt crisis that is going to last for 3 to 4 years. And the epidemic is going to imply a very large cost. In terms of consumption equivalence cost, this is going to be 1.8% loss in consumption. We're going to be able to analyze, sort of the different initial conditions in terms of debt. So what happens if countries start the epidemic with low or less or more debt than this baseline. And we find that if countries start the epidemic with less debt, then that's going to be very useful, because it's going to not only provide a mechanism to support consumption during this epidemic, but also is going to allow for more severe mitigation strategies that can save lives. In terms of our debt relief experiment, we find that sort of a back of the envelope here, a 10% decline in debt relief, in debt to output, okay, is going to benefit the country by about 14%, and is also going to benefit lenders, but by a modest amount. Okay, so this is the quantitative findings. Now I'm going to go on to the details on how we get these findings. In terms of literature, so our work is, of course, in the literature of this growing literature analyzing the macro effects of COVID-19. And we're sort of focusing on this debt crisis channel by building on the literature on sovereign default. We also relate to the literature on debt buybacks in terms of providing context of the gains in terms of social gains from potentially debt relief programs. Okay, so let's move to the details of the framework. So the model is going to be a small open economy model with a government and consumers that are homogeneous. The economy is going to be hit by this unexpected epidemic, and the epidemic is going to follow a standard epidemiological model for the susceptible, infected, and recovered model. Maybe many of you have seen sort of this growth of economics papers that are sort of adopting this type of framework to think about the mix of, what the effect of the epidemic for macro outcomes. The government is going to borrow internationally, okay, can default on its debt, and is going to decide on lockdown policies. And here, default and lockdown policies are going to be flexible in a sense that they're going to be allowed to vary in intensity and also in duration, okay? We're going to analyze the dynamics during the epidemics for population groups, consumption, and default and debt. And finally, we're going to use this framework to provide this debt relief counterfactuals. So the preferences are based, so the government here, the agents in this economy are going to value consumption and life, okay? You can think of this as this parameter chi here as sort of measuring a value of life. And that's going to be actually an important parameter in terms of sort of the outcomes of these policies. Output of the economy is going to depend on an economy-wide productivity, Z, and also on labor input, which is going to be reduced with lockdowns. And it's also going to depend on the population size of this country. The government is going to use international debt, borrow international, is going to use that to support consumption. So consumption, higher consumption is going to deviate from output because of these international debt operations. The government borrows at a price, QT, okay, and can also default on the debt that it owes, okay, and it's going to default with varying intensity given by this choice DT. Now, when the government defaults, okay, we are going to assume that the debt doesn't really dissipate, okay, but that the countries are carrying over a fraction of the defaulted debt as arrears and become debt obligations for the future. Default is costly, okay, and it's going to lead to productivity loss that is going to be proportional of the default intensity. Now, an important element in all these default models is the price that that is going to, it's like the borrowing rate that governments borrow at in international markets. And this price is going to compensate lenders for any losses from default. Okay, so the lenders are going to break even, they're going to be risk neutral, and the prices are going to be low when the default prospects are high. This type of framework generates defaults in equilibrium that happen when the debt of the country is high, the output of the country is low, or the prices of these new loans are low, meaning the interest rates are high. And this is going to happen when there are low repayment prospects in the future. Now on to the epidemic side. Okay, so here is going to be a standard SIR model where population transits from being susceptible to the disease to infected to the disease or to recover or diseased. A key building block in all these SIR models are the probability of new infections, how new infections happen. So new infections are going to increase when the disease is more contagious. So this is this parameter, this famous parameter R0. And also with the fraction of infected that are already in the economy. These population groups are going to be changing over time. So the number of susceptibles are going to fall with as this population becomes infected. The infected are going to evolve as they basically recover from the disease and become immune to the disease after being recovered, or to the sad state of diseased. You should think of it as that the infected have over 99% of probability to be recovered, and between 0.5 and 1% probability of dying, conditional on being infected. We are going to modify the standard SIR based on sort of this work. Say we're going to follow exactly actually Alvarez Argentilipi, where the lockdowns and the mitigation policies are going to impact the dynamics of the disease because they're going to reduce new infections. So a lockdown of size L is going to reduce the sort of the number of people that are sort of in the market and that are going to infect and that are also going to be infected. Okay. So basically, the lockdowns are going to reduce these the new infections, and by doing so, it affects the outcomes of this disease. So we're going to put this is basically combining these two things, the mathematics of it, of the epidemiological model with the sovereign default model into an integrated framework where sort of the states of the government are the population groups, how many people are infected, how many people are susceptible, how many people are diseased. The level of debt that the government has, okay? And the government is going to be choosing how much to borrow, how much to default, and how much mitigation to do in this economy to maximize these preferences that depend on consumption and also life. So this framework gives this result that when the epidemic hits, the prospects for repayment are lower, and that is and output is depressed with all the mitigation policies, and that is going to generate a default, and also is going to generate increasing spread. So it's going to generate a debt crisis. At the same time, the fact that there is these costly defaults and these sort of bad, very high interest rates for borrowing because of these future default prospects, that is going to make the lockdowns and mitigation policies more costly, which in turn can increase these actual fatalities from the epidemic. Okay, so that concludes the setup of the framework. Okay, now I'm going to show you some quantitative results. The quantitative results are going to depend, of course, on the parameters that we put in. We're going to, for the SIR parameters, we're going to follow some estimates in the literature, in particular, these estimates from the Diamond Princess study. This is an epidemiological study. So the key parameter, as I said, is this R0. The type of numbers we're going to use is 2.3 sort of number of people infected absent mitigation from this disease, which is sort of in the middle of the estimates for COVID-19. Another important parameter that I mentioned is the value of life. And we're going to use estimates for emerging markets, which is actually not very different from the estimates from developed economies, that basically give a sort of statistical value of life of about 9.6 million, for example, for the US, and we're going to adjust it for 20 years of life loss from COVID-19. For the debt parameters, we're going to follow the sovereign default literature. One important one we're going to think about is some sort of cost of default. And we're going to think about one of those parameters to target a debt to output ratio of about 30%, which is sort of in the ballpark of debt to output in many emerging countries prior to the epidemic. Let me show you now the quantitative experiments. So we're going to sort of spend some time looking at some time paths for the baseline economy that starts with this steady state level of debt of 30%. I'm going to show you some how the epidemic groups, lockdowns, fatalities, consumptions evolve over time. And then I'm going to consider a couple of alternative scenarios. One is where lockdowns are exogenous, are going to be 4 months of 50% intensity. And then also what happens if the countries start with less debt. Finally, I'll finish with the debt relief counterfactual. Okay, so this is the paths. Maybe some of you have seen this type of paths. The way that it works here is that the way you should read these plots is that at time 0, there is an exogenous, fraction of population that is infected. In our example, is 0.5%. And this is the outbreak of the epidemic. And what you can see, if you focus, say, on this dashed line, which is the example where we shut down the possibility of mitigation in our model, is that, you follow this epidemic dynamics. So the epidemic increases very rapidly. The fraction of infected increase to about 20%, sort of 20 weeks after the outbreak of the epidemic. The number of susceptibles sort of fall from 100%, almost 100% to very low numbers as more and more people in this economy get the disease. Now, what happens in the in our framework where when the economy is choosing sort of an optimal mitigation policy is that the outcomes of this epidemic can be altered, and it's altered significantly. So the fraction of infected at the peak of infections is decreases from about 20% to about 8%. This idea of flattening the curve is happening here with the mitigation policies. Not only you flatten the curve, but you actually change the outcome of the epidemic in terms of the fraction of people that eventually get the disease. So instead of 88% of the people getting the disease by abstracting from any mitigation, you'd reduce that to about 70%. As the epidemic progresses, the diseased fatalities increase over time. So just for reference here, absent any mitigation, the epidemic generates in our framework generates about 1% of the population dying from the epidemic. With the mitigation policies, that is going to be reduced by about half. So what are these mitigation policies? So on the right here, you can see the lockdowns, the optimal lockdowns. So you see that the path of the lockdown is a one lockdown, okay? It starts about 2 months after the outbreak of the epidemic. It lasts about 8 months, and it has about 3.5 months of a fairly high intensity above 40%. This mitigation policy is going to result in our model of a reduction in disease of substantially of about 0.5% of the population. Okay, what happens now with the economic variables? So the epidemic, as I told you, is going to generate, first is going to sort of reduce output, lockdowns, mitigation policies, prevent people from going to work, and is going, that in the model is going to reduce output by about 50%, because that is the size of the mitigation policy. Consumption is going to fall. It's going to fall by less. So the country is using some emerging international debt, okay, and default to support that consumption. But consumption falls equally very dramatically, about 70% here, 80%, and also it remains depressed even after the epidemic is gone. The epidemic is going to generate a debt crisis. So there's sort of this default on the right panel here. It's going to be a default that kicks on when the epidemic hits, and then it remains for about 43 months, between 3 and 4 years. So eventually the government will stop defaulting. It's sort of it's past these 110 weeks that I have in this plot. But sort of this, what we find here is that in this type of framework, because of the debt and the cost of default, the epidemic and the mitigation from the epidemic is going to generate a debt crisis that lasts well beyond the epidemic itself. So these are just all the plots again in one place for you to see. And again, I mean, this epidemic is going to generate a health crisis, of course. It's going to generate an economic crisis with depressed consumption output, and is going to generate also a debt crisis. Okay, we're going to tell you a little bit about these are two alternative scenarios now. So the first one is sort of these exogenous lockdowns. Suppose that I just think about starting a lockdown 1 month after the outbreak. Actually, many countries, many emerging countries started, there's measures of these mitigation lockdown measures that started very shortly after the international outbreak. And here we're going to get the lockdown at 50% for 4 months. Okay, this is the red line. And it's going to end abruptly after the 4 months. What you see here is that relative to, remember that now absent any mitigation, the fatalities was 1%. So here was reduced quite a bit, okay? But it doesn't really, it's much higher than this optimal lockdown, that it starts a little bit later, and it slowly relaxes. Moreover, the debt crisis from this exogenous lockdown doesn't really, is not really, better. It's actually a bit worse than this baseline. So this actually says that the timing of lockdowns are also going to matter for the outcome of the health crisis, but also the outcome of the economic and the debt crisis. What happens if the economy starts with less debt? Here, an example, I'm starting it with no debt. So you see that what happens is that the consumption is support consumption. The economy can use actually international borrowing to support consumption. That allows for sort of more stringent mitigation policies that are actually going to reduce the number of deceased. And of course, you know, almost completely avoids the debt crisis. So here is just the same thing, except just some summary statistics. Okay, so just in terms of the outcomes of the epidemics for different types of, these for the baseline, but also for these alternative scenarios. So to just sort of repeat a little bit. So in the baseline, we have that the number of deceased from the epidemic is about 0.5% of the population. Lockdowns are going to last about 8 months, but you know, less, like 2 or 3 months with high intensity. The output loss from the mitigation is going to be quite large, about 19% in present value, okay, in the optimal lockdown in the baseline here. In terms of welfare, so defaults are going to last about 3.5 years in the baseline. The welfare costs in terms of consumption equivalents here reported in present value is about 87% of output. So it's a large cost for this country. Lenders also lose, but the losses are much more muted. If you compare the exogenous lockdown, you can, I guess the main thing I want to say up here is that the mitigation is, the default is going to last longer, and the number of lives saved are going to be smaller than this optimal baseline. A little bit on, you know, high and low debt as initial debt. So you see here that with low debt, outcomes are better. Okay. With high debt, the default crisis can be very long. It can be, you know, even like 14 or 15 years it could last, because think about a country that is already starting with a bad initial condition, and then it faced this shock, COVID-19, that basically precipitates this sort of enormous debt crisis. Let me tell you the last thing about the debt relief counterfactuals. And I want to spend a little bit of time here. So what we're going to do is we're going to think about a debt relief counterfactual that lowers there's a sort of financial assistance entity. Think about the programs of the World Bank, the IDB, the IMF, that reduce debt to output of these economies by 10%. And think about reducing 10% of output for economies that start the epidemic with 10% of debt, 20, 30, 40, 50. Focus first on the baseline, which is this 30%. So what happens is that this debt relief program is costly. It's going to cost the financial assistance entity about 10%. It's not exactly 10 because it's actually buying the debt in secondary markets at a slightly depressed price. Okay, so these buybacks actually cost a little bit less than the reduction in the face value. But basically 10%, okay, costs them 10%. The country gains, how much does it gain? It gains about 14%. The lenders gain a little bit, about 1%, okay? So so the gains from these, now the gains in terms of the country, by the way, are in terms of consumption equivalents in present value. If you want to assess whether this program is valuable socially or not, you need some social welfare function. Suppose you weigh each of the three entities equally, okay? So you have, then the resulting social value from this program is about 47%, okay? So basically this is because the financial assistant puts down 10 and the country gets 14 and the lenders get 1. If you weigh so an alternative social welfare function would be, okay, I'm going to weigh I only care about the country and the financial assistance. Then those gains are a bit smaller, but still very substantial. Focus now on this second row here. If you think about an organization like these multinational organizations or any financial assistance entity actually, and is thinking about which country to provide the debt relief, and it cares about the well-being of the country, then we find that the biggest gains from this financial assistance are towards countries that are at the brink of a debt crisis. You see this non-monotonicity in terms of the social value with respect to the initial level of debt. Okay, so I guess I'm going to conclude. So let me conclude. So the pandemic creates this huge challenge from emerging markets. We've provided a framework that integrates the sovereign debt crisis with the dynamics from the epidemic. And we find that this is likely to generate not only health and economic crisis, but debt crisis. And we're actually seeing some of those outcomes already in many of the emerging countries. The second point is that lower debt burden is actually very helpful because it could prevent the debt crisis, but also it can allow for better mitigation policies. So in this context, the type of debt relief packages that are being provided and sponsored, but many of the international organizations are exactly on target. They are going to, in the context of our model, this is going to allow to basically reduce the costs from debt crisis and allow for better mitigation policies that can save lives. Thank you.
Thank you very much, Cristina, for it was a great presentation. Now we're going to start our Q&A session. Just to repeat the rules again, you have the option to raise your hand, and then I'll give you the permission to ask your question. And when I do so, please remember to turn on your microphone. So I'll start with Andrew Powell from IDB. Andy.
Hey, hi, Cristina. Hi. Thanks for the seminar. Really interesting. Just a couple of things. So maybe I missed it, but I mean, you obviously have a way of generating these long debt crises. So I'd be sort of interested in knowing more about the assumptions about what happens in default, because it wasn't entirely clear to me what happens in default. So that's point number one. Point number two, I mean, I don't think, I mean, debt relief in your model is basically a buyback. So I don't think that's not what the IMF, World Bank, or any other international financial institution that I know of is doing or is thinking of doing. So, you know, that's one thing that, if you could persuade somebody to do it, that's something they could do. But I was wondering if you had not thought about other types of things to evaluate in your model. I mean, actually, you know, we're very different, of course, to any other kind of lender. I mean, the IFIs, right? Because you basically have modeled commercial lenders who charge a risk premium, and then it's defaultable debt. But, you know, to a first approximation, we don't do that. We lend essentially at the riskless rate, and countries always repay us. I mean, that's what we say. So it's a very, and because countries always repay us because we're preferred, that's exactly why we can lend in these times. So we're the only guys providing money at the moment. You know, the private sector is run, and most countries don't have access. I mean, some do, but not many. And the only guys providing new money are the IFIs. So I would urge you to consider other kinds of relief, no? So providing new money at a riskless rate, where we don't differentiate risk, is another way of providing relief. And that's what basically the IFIs do. And we can do that in bad times because of our preferred status. Whereas the private guys, but what I don't really get in your model is why doesn't the country, why does it take so long to resolve a debt crisis? That's the underlying question that I have in the model that I see. Okay, thanks.
Thank you, Andy. Very important question. So let me start with the easy question, which is the first one. So, I mean, you have some work in terms of thinking about the default more as of a continuous type variable, not really as a as a sort of binary type yes or no variable. This is exactly what we're doing here. So default is you have the option to default every period, and what happens with defaulted debt is that part of it you carry as arrears. You can always borrow in our model, so there's not really like an exclusion period or a sort of a in the markets period. What happens though is that when you're defaulting a lot, the prices at which you could borrow, have fresh borrowing, are very, the interest rates are very elevated. So actually you choose not to borrow, okay? But there isn't, so the way that the way that these defaults get resolved, and this is actually based on, I should have said, this is actually, we lift this framework to think about an endogenous duration for the default episode from a paper that I have with Victoria's Rule and Javier Mateos Planas, who basically allow these decision of enter the episode and exit the episode. They treat those two decisions symmetrically. Okay, so when do you exit the episode? Turns out that you exit the episode when you the income or here when debt is sufficiently low that it's worth for you to pay the debt. And why do you want to pay the debt? Because it's otherwise you have this punishment in terms of, or these penalties, these costs in terms of resources. So that's the first question. The second question is, so let me answer a couple of ways. So one thing that would be equivalent to what we are doing with buybacks is to inject cash, say, to the country, and put a conditionality there that the cash has to be used to reduce, basically make the country buy back the debt. Okay, so that would be one way that, without really doing the buybacks, basically providing fresh cash to the country, it would achieve the same type of results. Now you say, well, the financial assistance cost, okay, is not 10% like you're saying, but it's going to be much lower because they are going to get paid in the future. Okay, so then we can modulate that, and maybe making adding a whole new loan might be very interesting, maybe a little bit difficult for what we have already, because we have these population groups in terms of state variables that are moving over time. But I think that's just modulating the cost of the financial assistance, so the same type of forces will be there, but it will just be just lowering the cost of the financial assistance with some future promises of repayment.
Okay, thank you, Cristina.
Yeah.
Now I'm gonna go to give the mic to Alejandro Izquierdo. Alejandro.
Yes, hi everybody. Hi, Cristina. Very nice presentation. I want to share a fact that will support what you just presented, and I also had a question. The fact that I want to share is that we've been looking at the sizes of the packages that countries have announced in Latin America for the coronavirus crisis. And we see that the size of the packages is negatively correlated with initial debt levels. No? So you see countries like Chile and Peru with very low debt levels that have announced very big packages, and then other countries with much higher debt with much lower packages. So that goes in the direction, I think, of what you had in mind. The question I had is related to something that we're thinking at IDB. We're not only pushing for policies that will, if you want, preserve companies and people, but we're also thinking of policies that will make us grow more in the future. No, and I think the model that you have may have a way to think about that. If you think that the government could somehow influence the productivity of the private sector. So I wonder if you used changes in the productivity of the private sector induced, say, by some public policy, whether that could have an effect in lowering the chances of getting into default, and in a way it could be another way of dealing with potential defaults other than debt relief.
Okay, Alejandro, gracias por las preguntas. Very interesting. We definitely, thank you for the fact. We'll definitely add it to our paper and check it because this is exactly what we are saying. We are saying that sort of the initial level of debt is going to influence the fiscal space of governments. I mean, maybe it's an obvious point, but it's nice to have, you know, people that have actually documented that for the case of COVID-19. So I'll definitely be looking at that. In terms of your question, I have a couple of thoughts, maybe a little bit outside the model. So one of the things that I worry about with these COVID-19 crises is sort of a full-blown sovereign debt crisis that resemble those nightmare debt crises of 1980s. And we don't really have a framework where after a debt crisis that is long and here we don't have a framework by hand, that a debt crisis that is very long is going to cause sort of a stagnant growth for a decade. We know growth, you know, it's like the great holy grail. So I think that sort of what we think about is that the cost of the debt crisis and actually will be even amplified in a model where debt crises have an effect on growth. We don't have that in our model, but it does point to the fact that sort of this epidemic could lead to a long debt crisis. You know, our experience suggests that that tends to influence growth. So that's one idea. The second thing is that so there are frameworks where, you know, other people have worked on frameworks where debt crisis is the channel by which sort of investment is depressed because of affecting the domestic financial sector and depressing the domestic financial sector and impeding sort of this reallocation of credit domestically. So that we're in pretty strong grounds. I mean, there's evidence that the debt crisis have caused that. So there you can see sort of a channel specifically that the debt crisis hurts the domestic financial system, and that is going to you know, depress investment and growth. The productivity channel I'm less familiar with, but certainly sort of reallocate. You can think about the reallocation of inputs towards more productive units is going to happen with better domestic credit allocation that is going to be hampered by these sovereign debt crisis. So that's a second channel. We can definitely think about you know, those issues, and I welcome that. But in the current framework, I guess what we want to point out is just this long debt crisis, which is already, you know, a big cost.
Thank you.
Yeah.
Thank you, Cristina. Now we have a question by Eduardo Cavallo. Eduardo. Eduardo?
Hello, can you hear me now?
Yes.
Yeah.
Okay. Hi, Cristina. Excellent presentation. Thank you very much for that. My question is somewhat related to Alejandro's, because one way of sort of simplifying the trade-off that countries, I think countries in the region face nowadays, is either you go very big in terms of the fiscal monetary stimulus to try to sort of offset or counteract the impact, the economic impact of this shock. And the risk of that is leaving a huge sort of debt overhang that will make recovery much harder thereafter. Or you sort of try to maintain some kind of discipline at the expense of a larger output collapse now, but with the expectation that you know, your creditworthiness will remain stronger as you come out of the crisis, and therefore the recovery will be faster. No, so in terms of your model, this is a difficult trade-off to assess, because you know, one affects the debt, the other one affects the output, and at the end you are looking at the debt to GDP. So I wonder whether you have given in the context of your model any thought to this trade-off, and what kind of things do you think countries in the region or governments in the region should be looking at in order to decide what side of the trade-off they should lean on? Thank you.
Thank you for the question. So I completely agree. Every country is going through a very difficult situation, and emerging countries with their susceptibility to debt crisis and that the inability to raise funds at very cheap rates are very much in a difficult situation. About the trade-off, see, we are in our model. We are thinking about a centralized type. So let me just say, I don't know if there's a very large trade-off in the following sense, okay? I don't know, we are silent as whether the government imposed lockdowns are any different than what the people would choose by themselves, okay? So if you think about lifting the lockdown, I mean, I don't know if in Minnesota we're opening up, I'm going to make my choices in terms of where I'm going to go. So I think that is happening. So we are not really married to whether it's the government that can actually change much the outcome. Okay, because it is just going to depend on, people are wanting to they're facing the trade of themselves. They are in the informal sector. Do they want to go out versus risking themselves more with the epidemic versus trying to sell stuff in the markets. So it's a very difficult situation. I guess what we're trying to think here is that the debt part, okay, the sort of the debt, how I guess as international organizations, or how we view debt, okay, this is very costly. The fact that these countries are having these very high levels of debt, or this risk of susceptibility of debt crisis, is adding sort of an extra problem to the situation, okay, that I'm not sure there's trade-off, no trade-off, but it's like making things worse. And so just sort of, that's something that, potentially could be modulated. And that's where we come in.
Okay, thank you, Cristina. Yeah. We have another question by Andy, but before that, I'm going to ask a question myself that I was curious. I think this exercise of debt relief, very interesting, because in this model now, if you save lives, you have a higher output later on forever.
Yeah.
Right, productivity. Is there a way to compare this to other types of crises? Like have you do this type of exercise of debt relief? Because what is different now to other crises? Because I think debt relief is always on the table in big crises, right? What is this gain coming from, especially?
Okay, thank you for the question, Joel. So actually, the majority of the including thinking about debt buybacks. Okay, so if you just think about the debt buybacks literature, they've had sort of the hard time getting the gains for the country, because the gains are, the lenders are ripping most of the gains because they get the bigger sort of capital gain. And we have a big gain for the country, okay? So actually we looked into it. And the one reason is that in this shock, by doing the debt relief, okay? So first, by doing the relief, you can modulate the mitigation policies that can save lives. And that component, so the value of lives, $9 million, okay, in the US, or equivalent to other countries, is like a big deal, okay? And so having these two types of goods, not only the consumption, but also this other one, okay, is going to, it actually is the source of the gains from the debt relief.
Thank you. So now I'm gonna pass the mic to Andy Powell, please. Andy?
Hi, thanks. Hello?
Yeah.
Okay, thanks again, Zhao. Yeah, double dip.
Yeah.
So, yeah, so now I understood about how you get the traction from the debt buyback, and that's interesting because obviously you have a lot of other stuff going on in your model compared to those old models of debt buybacks, and that's interesting. I think that's very interesting. Of course, again, if we lend a country money, it could use it to buy back debt, but generally we don't like that. Generally, we think it's better for the country to use our money for consumption or investment. maybe have a harsher default on the private sector. So that would be something interesting to evaluate in your context.
Yeah.
You know, that might be even more valuable for the country than using money to finance a debt buyback. But I wanted to.
So this one, by the way, this one we can definitely do. So I'm gonna with the concept we do just to. It's an actually a to-do list. What would happen if instead of a buyback you get cash? That is fairly easy for us to do. So we can.
Okay.
We'll get back to that on that.
But then I wanted to come back to, because I think it's this issue of the cost of the debt crisis that's really crucial in your model. And you know, it's obviously something I've been thinking about, and now I understand. So basically you have a bunch of partial defaults over time. In the model that I worked on, we had sort of lumpy restructurings, as we called them, or reprofilings, but they weren't every year. But you know, so I have sympathy for that. And you know, I understand that creditors sort of want to keep the country on a, you know, it's hard for the creditor to give away too much, and you want to keep the country on a short lease, as it were, like a dog on a short leash. But then that means the probability of a default the next period is high. You obviously have these arrears going on in the background as well. So it's not that this, when you even have a haircut, it's not that this debt is then wiped out. It's somehow still there as arrears. So that's interesting. But my main question was, you know, when I look around, so I mean, there are a number of countries that you see that have had these multiple restructurings, which is why we wrote our paper. Actually, the probability of a restructuring is pretty high, which was the motivation. But you know, I looked at the other countries where it's taken a long time to restructure. I mean, Argentina being the obvious case, and it's not really a series of partial defaults. It's basically, you know, tremendous uncertainty, perhaps, about what haircut is required, and creditors, and you know, creditor coordination problems, all the legal issues, the complexities, and you know, and hence it takes years to come to an agreement. And then if I think about
Andy, sorry, we have a queue of questions, so if you could resume,
okay,
please.
And then I think about the 1980s, and I think the big difference there was, you know, the banks didn't want to realize the losses on their balance sheet. So the big advantage we have with bond debt is that those losses do get realized more quickly. We don't necessarily have that problem of bank debt. So I'm just wondering whether we really have this issue that you point to in your model of these big debt problems, or where maybe countries will be able to solve this more quickly by themselves.
Yeah, so yes, so defaults, debt crisis, these are very complicated, intricate events and renegotiations. So what we did in the paper with Javier and Victor is that we tried to look at data of defaults, you know, the paths of debt repayment that happened during default, the default episodes, haircut the data, and we tried to basically put that whole framework into this framework of partial defaults and choosing partial defaults over time. And there we have details onto how to map sort of the observables that you're describing into the variables of the model. Okay, so we do have that exercise there, but I agree. I mean, you know, you're not going to have all these details in this model, but that framework was successful to generate some patterns in the data, like delays or long defaults, small defaults, big defaults, and some correlations. And so that's why we were using that framework in this paper, because basically it allows us to talk about some length and intensity of the debt crisis. Thank you.
Thank you, Cristina. Do you mind if we take 2 more questions? I'll ask them to be quick.
Ahead. No,
remember,
I'm totally fine, actually.
Perfect. Okay, now we have Tito Cordella. Tito.
Hi, Cristina.
Hola.
Very nice presentation. I have just a quick question. I wonder whether instead of the day buyback, you are considering a sort of lending to buy some collateral like in the already deals. So in the sense that the IFI Swiss land, so the country can buy some zero coupon bond, can be posted as collateral vis-a-vis future lending. Would this give more or less leverage than that buyback?
Yeah, let me see if I can give you some answer. So in the paper that there might be it might be a good thing. I haven't thought about it, Tito, so that's good. I have to think about it. But one thing that actually I didn't present in the paper, but the quantitative results have, is that we do have a long maturity debt to begin with. Okay, so we have these legacy lenders that basically by different type of debt relief programs, you could get them to take a bigger or larger haircut. Okay, and right now the debt buybacks, actually the lenders gain. They gain a little bit, but you know, relative to the country, but still it's positive. So with the debt buyback, I can get the lenders to take a hit actually relative to without the program. And you know, you might want to, you might not want to, but I think alternative ways to structure this debt relief that can get the lenders to take a hit from these costs or increase the cost from the epidemics to them might lead to different outcomes. So I will definitely explore the possibility of the collateral avenue that you're describing. Thank you, Tito.
Okay, so now let's go to the last question by Victoria Nuger. Victoria. Victoria? Okay, let's just wait 5 seconds, otherwise.
Yeah, maybe she can write it in the panel, or
yeah.
if she's having problems.
Victoria, or you can message my phone. Yeah. Whatever you want. Let's just wait 5 seconds, otherwise we close it. Okay, maybe she pressed by mistake. Okay, so thank you very much, Cristina. It was great to have you.
Yeah, thank you everybody. It was great to be able to present in this forum. I appreciate it.
Okay, bye bye.
Bye bye.